we've listed different ways that you can invest. So now let's go through each of those options in more detail. The first one is common stock. If you buy a company's common stock, that makes you a part owner in that company. So each share represents a share of ownership. And so you have greater returns possibly from stock if you take on higher risk. And stock is probably one of the more risky investment options of the ones that we're going to discuss. Next, there's bonds. With bonds, you become a creditor of the firm instead of an owner. So you're basically giving them an IOU. In exchange, the firm or the government that you're lending money to will send you coupon or interest payments. And so the value of those bonds move in the opposite direction of interest rates. So if interest rates go up, bond values go down, and vice versa. Next, there are these kind of hybrid securities. One is preferred stock, and so that's actually stock, but really behaves more like a bond because the coupon payments are, or the dividend payments are set kind of like the coupon payments on a bond, and you don't get any voting rights associated with these preferred securities or preferred stock. Convertible securities are a special type of bond that allows you to convert that bond into stock under certain conditions. Mutual funds are another way to invest. With mutual funds, investors pool their money for a money manager to actually invest in individual stocks, bonds, or whatever it is that money manager has decided or announced in their prospectus that they will invest the funds in. So similar to mutual funds, there are exchange traded funds. This is also a pooled security, or exchange traded notes. Real estate. Real estate is a little more difficult to use as an investment option in your portfolio because it can be anything from actually buying apartment buildings or single family or multifamily homes, or investing in a real estate trust. The securities markets are arenas or marketplaces where these different financial instruments that we've been talking about are traded. So we divide the securities markets in what's called into what's called capital markets and money markets. Capital markets are typically for long-term securities and long-term transactions, and the money market is for short-term securities. And we define long-term and short-term with 1 year as the threshold. So anything with a maturity of 1 year or less we consider short-term, greater than 1 year is long-term. Now, the way securities trade is considered primary market transactions or secondary market transactions. In the primary market, a security is being sold for the very first time. So an investment bank would underwrite the deal and the issuing company would get the proceeds. So if XYZ company wants to raise money by issuing new stock, that would be a primary market transaction. You would get a prospectus and there would typically be an investment bank involved. In the secondary market, that's where securities are resold. So the issuing company is out of the deal. Now you just have individual investors reselling amongst each other on the securities exchanges. More terminology are broker and dealer markets. In a broker market, this is where buyers and sellers come together, and a broker is potentially selling stocks or selling securities out of the, sorry, I got that one mixed up. A broker is bringing buyers and sellers together. So brokering a deal, bringing the buyers and sellers together. In the dealer market, the buyers and sellers never meet. that is where dealers act as what are called market makers. So they will sell the securities out of their own inventory. So here's kind of a breakdown of the secondary markets with broker markets and dealer markets. So explaining the various exchanges that fall in one category or the other. So the way dealer markets work, remember, this is where we're bringing buyers and sellers together. So a bid price, and you can think of eBay as an example that tends to help people understand what's the bid and what's the ask. The bid price is the price at which an investor can sell a security. So I'm going to bid X number of dollars for a particular security. A seller is going to ask the asking price. That's the price that they are willing to accept. So these definitions are a little bit fuzzy. So if you think about eBay, that might make more sense. And then there are also foreign securities markets. There are several organized securities exchanges in many, many countries around the world. Some are more developed than others, and they each have their own specific trading rules. There are also regulatory bodies that are involved or regulate the securities markets, and there are specific laws in each state that govern securities sales. And so those folks who are selling securities have to be registered with these various regulatory bodies, which also gives investors an opportunity to check out these dealers and make sure that they have a solid record and reputation. And so there are various regulations or securities laws that help to ensure that markets run smoothly. And most of these, if not all of these acts, were put in place to protect the small investor, because it's very easy to get taken advantage of, because this is very different from putting money into a savings account where you have some deposit insurance. Here, you have the potential for losing your entire investment. So we have to have some rules and regulations in place to protect investors and kind of level the playing field. So that's the main job of the SEC, which is the Securities and Exchange Commission, to level the playing field for all investors.